The red line has been crossed, the bluff has been called, and the single most important commodity in the global economy has just been taken hostage by a superpower. We are recording this emergency update because the charts you're looking at, if you are lucky enough to have a live data feed, are showing something that hasn't happened since the Hunt brothers cornered the market in 1980. Silver is up plus 7.9% in a single trading session. To the uneducated observer, this looks like a good day for the bulls. The mainstream financial media, Bloomberg, CNBC, the Wall Street Journal, are already spinning the narrative. They are calling it a technical rebound. They are calling it a short covering rally, triggered by a weak dollar. They are lying to you. What happened at 9 TKOAM Shanghai time this morning was not a technical event. It was a geopolitical act of war. The Ministry of Commerce of the People, as Republic of China, has officially activated the Strategic Resource Export Control Mechanism. The export licenses that we warned you about for months, the ones the skeptics said would never be enforced, have just kicked in. As of this morning, the Great Wall of Silver has been erected. We have received confirmed reports from logistics brokers in the port of Shanghai and Shenzhen that customs officials have ceased processing all outbound shipments of 999 fine silver bars and industrial silver powder. Containers that were sealed, weighed, and manifested for delivery to Apple in California and BMW in Munich have been flagged, halted, and rerouted to state-controlled warehouses. The plus 7.9% explosion you see on the chart is not speculation. It is the sound of the global supply chain snapping. The Western banking cartel, JP Morgan, HSBC, the entities that manage the COMEX, woke up this morning to find that their primary source of physical liquidity had vanished. They went to the cupboard to get the metal they needed to suppress the price, and the cupboard was bare. This price move is the market's violent realization that the free trade era of silver is over. For 50 years, the West has enjoyed a privilege. We could print paper money and exchange it for hard resources from the East. We could export inflation and import deflation. China would dig the holes, refine the ore, and ship us the shiny bars for $20 or $30. Today, China said, no more. The 7.9% jump is just the initial shockwave. It represents the immediate repricing of risk, but it does not yet price in the reality of the shortage. The algorithms that run the paper markets are currently confused. They are seeing a supply shock that does not fit their historical models. They are trying to find a seller to cap the rally, but there are no sellers. The ask side of the order book has evaporated. If you are holding paper silver, SLV, unallocated accounts, or futures contracts, you might look at your screen and feel rich today. You see the green candle and you celebrate, but you're missing the most dangerous part of this story. The price on the screen is rising, yes, but the availability of the metal is falling to zero. The export licensed regime effectively nationalizes China's entire silver output, which accounts for a massive percentage of the global refining capacity. This means that while the price is up 8% in London, the premium to actually get physical delivery in Asia has just blown out to 20%, 30%, even 40%. We are witnessing the beginning of the bifurcation, the separation of the paper price from the physical reality. The explosion has started. The fuse was the export ban, but the bomb is the empty vault in London that can no longer be refilled. Are you ready to see exactly how the export license trap works? Are you ready to see why this isn't just a temporary halt, but a permanent seizure of the future? Let's dive into the details. To understand why this plus 7.9% move is just the tremor before the earthquake, you have to look at the fine print of the document that was released in Beijing at midnight. The media is calling it an export license requirement. That sounds harmless. It sounds bureaucratic. It sounds like something that can be fixed with a few forms and a stamp. But that is the genius of the trap. China didn't announce an embargo. An embargo is an act of aggression that invites retaliation. Instead, they announced a compliance update. They simply stated that due to national security concerns, all silver products capable of being used in military or dual-use applications must now undergo a 45-day security review before leaving the country. Here's the catch. Everything is dual use. The same 999 fine silver shot that is used to make a Tiffany necklace is the exact same silver shot used to make the guidance chip in a Tomahawk cruise missile. The same silver paste used in a consumer solar panel is the same paste used in a military satellite. By invoking the dual-use clause, China has effectively granted itself the legal right to seize every single ounce of silver production within its borders without technically declaring a ban. We are receiving reports from bullion dealers in Hong Kong who tried to move product this morning. They submitted their export applications at 9:01 a.m. At 9:05 a.m., they received a digital notification. Application received. Estimated review period. Indefinite. This is a pocket veto. They aren't saying no. They're just putting the global supply chain into a coma, And here is where the weaponization of the supply chain hits the Western banking system in the jugular. The London Bullion Market Association, LBMA, and the COMEX rely on a list of accredited refiners. These are the companies whose bars are accepted for settlement. If you look at the good delivery list, a massive percentage of the world's refining capacity is located in China. As of this morning, those refiners have been paralyzed. They cannot ship bars to London to restock the vaults. They cannot ship bars to New York to settle futures contracts. So, what happens to that metal? Does it just pile up on the docks? No. This is the second part of the trap, the part the Western media is completely missing. While the export gate is closed, the internal vacuum has been turned on high. We have intelligence that the State Reserve Bureau, SRB, of China has issued a domestic procurement directive. They are buying the trapped inventory. They are sweeping the floors of the refineries. And they are doing it at a premium that makes the COMEX price look like a joke. They are paying in yuan, they are keeping the metal in country, and they are allocating it to their own strategic industries, to Huawei for 5G, to BYD for EVs, and to the PLA for defense applications. This creates a terrifying reality for the Western banks. The metal they need to cover their shorts isn't just delayed. It is being consumed, it is gone, it is being soldered into circuit boards and locked into state vaults from which it will never return. The plus 7.9% spike you see today is the market waking up to the realization that the COMEX is now a zombie exchange. It is trading paper claims on metal that is legally forbidden from entering the warehouse. The ARB is dead. Usually, when the price spikes, arbitrage traders buy metal in China and ship it to London to capture the spread. That mechanism is now illegal. The Western banks are trapped in a cage with a tiger, and the door just locked from the outside. They can print dollars, but they cannot print export licenses. And while the banks panic, the industrial giants of the West, Samsung, Tesla, Apple, are about to make a move that will turn this 7.9% rally into a vertical line. Are you ready to see what happens when a trillion-dollar tech company realizes its supply chain has been cut? We have established the geopolitical checkmate. We have established the empty vault. Now, we must turn our eyes to the entities that are currently screaming the loudest behind closed doors. We are not talking about the banks. We are talking about the trillion-dollar industrial complex. While you were watching the ticker tape flash plus 7.9%, a very different kind of panic was erupting in the boardrooms of Silicon Valley, Seoul, and Munich. The export license notification from China didn't just hit the trading desks, it hit the supply chain procurement officers of the world's largest technology companies, Apple, Tesla, Samsung, Raytheon. For the last 20 years, these companies have operated on a just-in-time inventory model. They believed the lie that the global silver market was a bottomless grocery store. They believed that if they needed 5 million ounces of high-purity silver for a new iPhone run or a solar array, they could simply place an order in London and have it delivered next week. At 9 a.m. this morning, that belief died. When China locked the export gate, they didn't just cut off the flow of bars. They cut off the flow of value-added components. The specific silver pastes and powders mentioned in the dual-use restriction list are the blood of the tech industry. You cannot build a solid-state battery without them. You cannot build a 5G tower without them. You cannot build a Tomahawk missile guidance system without them. So, what are these companies doing right now? They are bypassing the broken market entirely. We are receiving confirmed reports of massive off-market block trades executing throughout the day. These industrial giants are not buying futures contracts on the COMEX. They know a paper contract is useless if the metal is stuck in Shanghai. Instead, they are engaging in a panic bid for physical inventory already located in the West. They are calling the refineries in Switzerland. They are calling the wholesalers in New York. And they are saying, we don't care what the spot price is. We don't care that it's only up 8%. We will pay you a 30% premium. We will pay you a 50% premium. Just secure the metal and get it to our factory. This is the shadow squeeze. While the retail investor looks at the screen and sees silver at $34 or $35, the industrial price of silver, the price to actually get the material to build a product, has just gapped to $50 in private transactions. This creates a terrifying dynamic for the bullion banks. The banks are short. They need to buy metal to cover their positions. But every time they reach for a bar, a giant hand from the tech sector reaches out and grabs it first. Samsung has deeper pockets than JP Morgan's commodities desk. Tesla needs the metal for survival. The bank only needs it for a trade. Survival beats speculation every time. The 7.9% move you see today is just the paper market trying to catch up to the industrial market. But it's too slow. The gap is widening. The industry is vacuuming up the float. The ghost inventory that usually sits in the system to provide liquidity is being drained by corporations terrified of a production halt. And do you know who's left holding the empty bag when the industry takes it all? You, the retail investor, the person holding an ETF, the the person with an unallocated pool account. The banks are about to sacrifice you to save themselves from the industrial squeeze. They are about to pull a maneuver that will leave you with a cash settlement, while the real metal disappears into the vaults of a battery factory. Part 4. We have to talk about the kill switch, the legal weapon that is currently being primed in the back offices of every major ETF and digital silver platform. If you think you own silver because you have shares in a trust or digits in a banking app, you are about to receive a very expensive lesson in property rights. While the industrial giants are paying $50 an ounce in the shadow market, Part 3, the banks are preparing to execute the cash settlement protocol. You need to understand the position the banks are in. They are short millions of ounces of silver. They are legally obligated to deliver that metal. But the metal is stuck in China, and the rest is being hoarded by Samsung and Tesla. They are facing a delivery default. In a free market, a default means the price goes to infinity. If you sold something you don't have, you have to pay any price to get it. You have to bid $100, $200, $500 until someone sells. But the COMEX is not a free market. It is a managed casino, and the house does not like to lose. So instead of bidding the price to infinity, they are going to use the force majeure clause found in the fine print of your user agreement. We expect that within the next 24 to 48 hours, the major exchanges and ETF custodians will issue a notice citing extraordinary market conditions due to the Chinese regulatory changes. They will state that physical delivery is currently impracticable, and then they will pull the trapdoor. They will close your position without your permission, they will liquidate your silver holdings, and they will put cash in your account. But here's the theft. They will pay you out at the official price. They will pay you the spot price you see on the screen, the price that is only up 7.9%. They will say, here is your $34. You made a profit. Go away. But while you're staring at your $34 settlement, the real price of silver, the price to actually buy a physical bar in the real world, will be rocketing past $50, $60, $70. You will be cashed out of the asset class right before the super spike. This is the soft default. It doesn't look like a bankruptcy. It looks like a glitch. It looks like a refund. But make no mistake, it is a confiscation of wealth. The banks are essentially saying, we cannot honor the contract, so we are canceling it. Here's your fiat currency back. Good luck finding real metal. By the time you get that email, the physical window will be nailed shut. The dealers will be sold out. The premiums will be 100%. You will be left holding a bag of depreciating dollars while the train leaves the station at Mach speed. This is why we warned you to get physical. If you can't touch it, you're just an unsecured creditor to a bankrupt entity. And while the retail investor is getting liquidated, a massive shift is happening at the source of the supply. The people who dig the metal out of the ground have just made a decision that will seal the fate of the Western banking system. We have the Chinese government locking the gate. We have the Western banks defaulting on retail investors. We have the tech giants panic buying the float. But there is one final group that has decided to twist the knife, and their decision is the one that makes this crisis permanent. The miners. For 40 years, the primary silver producers, the companies pulling the metal out of the ground in Mexico, Peru, Poland, and Australia, have been the battered victims of this scheme. They took all the risk. They dealt with the strikes, the geology, the environmental regulations. And in return, they had to sell their product at a price rigged by a computer algorithm in New York. If the banks smashed the price to $20, the miners starved. If they smashed it to $15, the miners went bankrupt. They were price takers. But intelligence from inside the mining sector confirms that, as of this morning, the dynamic has flipped. A producer's revolt is underway. Put yourself in the shoes of a mining CEO right now. You're looking at two prices on your screen. Price A, the COMEX London spot price of $34, up 7.9%. Price B, the shadow bid from Samsung, Tesla, China of 50 plus. Where are you going to ship your metal? Are you going to sell your concentrate to a COMEX-approved refiner in London so JP Morgan can use it to short the market against you? Or are you going to ship it to a battery factory in Seoul that is begging for your product? The answer is obvious. We are witnessing a supply diversion on a global scale. We have reports of cargo ships that were scheduled to transport silver concentrate from Manzanillo, Mexico, to Western ports, being remanifested in the middle of the ocean. They are turning west. They are heading across the Pacific. They are bypassing the LBMA entirely. This means that starting today, the COMEX won't just be low on inventory, it will be cut off from the bloodstream. The pipeline is being redirected. The West is being starved. This is the ultimate nightmare for the LBMA, London Bullion Market Association. Their entire fractional reserve system relies on a constant flow of fresh metal entering the vault to replace the bars that are being withdrawn. It relies on the churn. If that flow stops, if the miners join the China block and sell directly to the end users, the London vault goes mathematically empty in weeks. The miners have realized that the paper price is a lie. They have realized that their product is the most strategic element on the periodic table, and they are no longer willing to subsidize the Western banking system with their assets. By pivoting to Asia and the industrial direct market, the miners are effectively enforcing the export ban globally. They're helping China corner the market, not out of political loyalty, but out of pure capitalist survival. The supply cliff is here. The water is still flowing out of the tap in London, but the reservoir behind it is dry. The miners just cut the pipe. In Part 6, we will explain exactly what happens when the gamma recoil hits a market with zero supply, and why the 50 price target is just the starting line. Are you ready for the explosion? We have arrived at the moment of kinetic release. This is the chapter where the laws of physics take revenge on the laws of financial manipulation. In the trading world, they call it a short squeeze. But what is coming next, now that the miners have cut the line and the export ban is live, is something far more violent. It is a gamma recoil. To understand the violence of what is about to happen, you have to visualize a high-tension steel spring. For 40 years, the Western banks have been compressing this spring. They have used billions of dollars in paper leverage, naked shorts, and spoofing algorithms to push the price of silver down, keeping it artificially cheap despite exploding demand. They have held the beach ball underwater with the weight of the entire fiat system. But at 9 a.m. this morning, China removed the hand holding the ball. When the markets attempt to price in the reality of zero supply over the next 48 hours, the banks are going to lose their grip. Here is the math that terrifies the risk desks at JP Morgan and Citibank. To suppress the price, the banks have to be net short. They have to sell contracts they don't have. This means that at the absolute bottom of this export ban rally, they are holding their maximum short exposure. They are most vulnerable at the exact moment the trend reverses. As the price bounces off the bottom, driven by the industrial panic bid, Part 3, the banks are instantly underwater. Their losses aren't linear. They are exponential. And here is the trap they built for themselves. To stop the bleeding, they must buy. But who are they buying from? They can't buy from the miners. The miners have diverted their ships to Asia. They can't buy from the retail public. The dealers have locked their doors or are sold out. They can't buy from the east. The export gate is welded shut. This creates a gamma squeeze. As the price rises, the market makers, the entities that sold options to the hedge funds, are forced by their own risk models to buy futures contracts to hedge their exposure. They become forced buyers in a market with zero sellers. They will be chasing a ghost. The high-frequency trading algorithms that are currently trying to cap the price at plus 7.9% are programmed to flip. Once silver crosses the key technical resistance levels, likely reclaiming the $40 level within hours, the sell bots shut off and the buy bots turn on. But this time, they will be bidding into a vacuum. There is no offer. There is no liquidity. We are predicting a gap-up event that will make history. The price won't drift up politely. It will teleport. You might go to bed seeing silver at $34 and wake up to see the first trade execution at 50. The chart will simply print a vertical line. The Western banks tried to create a technical breakdown to hide the shortage. Instead, they have loaded the slingshot for the greatest technical breakout of the decade. The plus 7.9% move today was the pullback. The release is next. And the target is no longer the old high. The momentum from this recoil has the mathematical energy to push us straight through to numbers that sound ridiculous today. You think $50 is the target? $50 is the floor. $50 is where the industry starts buying just to keep the lights on. The real price discovery happens after the banks are liquidated. The banks built a trap, walked inside, locked the door, and handed the key to Beijing. Now, the spring is uncoiling, and they are standing right in front of it. In Part 7, we will discuss the bifurcation, endgame, where the paper price might crash to zero while the physical price goes to the moon, and why you must be on the right side of that split. Are you ready for the final separation? We have arrived at the final frontier of this crisis. This is the chapter where the financial world, as we know it, breaks in half. We are no longer talking about a correction or a rally. We are talking about the great bifurcation. For 50 years, the global silver market has operated on a single fragile assumption, that the post-to-paper price on the COMEX and the physical price in your hand are the same thing, that they are tethered together by arbitrage. But as of this morning, with the Chinese export ban live and the miners cutting off the West, that tether has snapped. We are about to witness the death of the spot price. In the previous part, we discussed the gamma recoil driving the price up. But here's the twist that will destroy the portfolios of millions of unprepared investors. The paper price might eventually crash, even as the physical price goes to the moon. How is that possible? Imagine a betting parlor that takes bets on horse races. But one day, the horses stop running. The track is closed. The betting parlor continues to operate, letting people bet on imaginary races. They can trade betting slips back and forth. The price of those slips might go up or down based on sentiment, but you can never, ever cash out that slip for a real horse. That is what the COMEX is becoming right now, a zombie casino. As the physical shortage bites over the next 48 hours, the liquidity in the paper market will dry up. The banks, realizing they cannot deliver metal, might actually crash the paper price in a final attempt to discourage buyers, or simply to make their cash settlement payouts cheaper, as we saw in Part 4. You could see a scenario where the screen says silver is $30, but you cannot buy an ounce of physical metal for less than $100. This is the bifurcation. The spot price ceases to be a price. It becomes a panic index. It becomes a meaningless digital number that only applies to people trapped in the matrix of ETFs and futures. Meanwhile, the real price discovery will migrate. It is leaving New York and London. It is moving to Shanghai. Since China now controls the supply via the ban and the refining capacity, the Shanghai Gold Exchange, SGE, becomes the only market on Earth where price equals delivery. We are already seeing the Shanghai premium blow out to record levels. While Western investors argue over pennies, Chinese industrial buyers are setting a floor price that is 30% higher than the rest of the world. This is the shift of global pricing power. The dollar hegemony over commodities is ending in real time. If you are holding physical silver, this is the moment of maximum validation. Your metal is no longer priced by a corrupt bank in New York. It is being repriced by a hungry factory in Shenzhen. But if you are holding paper, you are standing on the wrong side of the fault line. You are holding a claim on a bankrupt system. When the split happens, when the paper price goes to zero and the physical price goes to infinity, you will be left holding a bag of worthless receipts. The COMEX is a burning building. The physical market is the fire exit, and the door is almost shut. We have traced the entire collapse. The ban, Part 1, the trap, Part 2, the industrial panic, Part 3, the retail theft, Part 4, the minor revolt, Part 5, and the gamma squeeze, Part 6. Now, only one question remains. How does this story end for you? We have reached the end of this emergency briefing. We have analyzed the export license trap. We have exposed the industrial panic bid. We have tracked the minor revolt and the gamma recoil that is currently tearing the paper market apart. The yellow tape has been wrapped around the crime scene. The evidence is conclusive. The Pulse 7.9% explosion you're seeing on your screen today is not a victory. It is a warning siren. It is the sound of the Western financial system screaming as the physical foundation is ripped out from under it. The bifurcation we discussed in Part 7 is not a theory for next year. It is the reality for tomorrow. The world has just split into two distinct timelines, and you have to decide, right now, which one you are living in. Timeline A, the paper world. In this timeline, you look at the COMEX spot price, you trust the bank, you hold your wealth in ETFs and unallocated pool accounts, you see the price go up, and you feel smart. But when the force majeure email hits your inbox, when they cash you out at the manipulated official rate, you will realize that you never owned anything. You were just a creditor to a bankrupt casino. Timeline B, the physical world. In this timeline, you understand that price is irrelevant without possession. You understand that AA compliance updates in Beijing just nationalize the strategic supply of the 21st century. You hold the metal, you ignore the volatility, and you watch as the purchasing power of your stack decouples from the dying dollar and recouples with the rising industrial demand of the East. The trap is set. The algorithm is live. The banks are counting on your conditioning. They have trained you for 50 years to believe that the screen is the truth. They are betting everything that when they flash a cash settlement offer, you will take the paper and run. Do not give them that satisfaction. Here is your final directive for the days ahead. 1. The screen is a lie. Do not trade your physical reality for a digital illusion. If the spot price crashes tomorrow while premiums soar, do not panic. That is the death rattle of the paper market. It is the phantom price. If you sell into that dip, you are donating your family's future to the very entities that suppressed it for decades. 2. The spread is the signal. Stop looking at the ticker. Start looking at the out-of-stock signs. Start looking at the difference between the London price and the Shanghai price. That spread is the measure of the shortage. When that spread widens, the dam is breaking. 3. Possession is victory. The era of financialized silver ended at 9 a.m. this morning. We are now in the era of strategic silver. If you cannot hold it in your hand, you do not own it. You simply own a promise from a liar. Get your metal out of the system. We have the intel. We see the data. The silver bomb has been detonated. The shockwave is moving through the supply chain now, and it will hit the retail public with devastating force in the next 48 hours. You have been warned. The vault is empty. The East has the metal. The West has the debt. And the only thing standing between the banks and total collapse is their ability to trick you one last time. Secure your stack. Ignore the noise. Let them burn in the trap they built for you. subscribe to the channel, turn on the notifications. We will be live as the bifurcation accelerates. The heist is over, the panic is next. Class dismissed.